So financial reporting. So far, we have covered chapter 1. And in chapter 1, we have just revised the previous things relating to financial accounting, the initial paper of accounting in ACC. So from today onward, we will start learning about different accounting standards. So in this paper, we need to learn some accounting standards. Just give me a moment. So let's move toward chapter 2. That is about tangible non-current assets. Chapter 2, tangible non-current assets. And in this chapter, we're gonna study 3 different accounting standards. We'll study one accounting standard IAS 16, that is property, plant, and equipment that we have already learned in financial accounting paper. We'll discuss about IAS 20, that is about government grant. And we will discuss about IAS 40, that is about investment property. In this chapter, we will learn 3 accounting standard: IAS 16, property, plant, and equipment; IAS 20, government grant; and IAS 40, investment property. And all these 3 standards are relating to tangible non-current assets. Tangible non-current assets. So let's discuss IAS 16 first. IAS 16, property, plant, and equipment. Property, plant, and equipment. What are property, plant, and equipment? Tangible non-current assets: land and building, plant and machinery, motor vehicle, furniture and fixtures, all are part of property, plant, and equipment. What are property, plant, and equipment? Land and building, plant and machinery, motor vehicles, and furniture and fixtures. Property, plant, and equipment are tangible assets held by an entity for more than one accounting period for use in production. Mean either we use them in production or supply of goods or services like motor vehicle in production, plant and machinery, land and building for rental to others, or for administrative purpose like building. Either we rent to others or we use in the business. Furniture fixtures we use in the business for administrative purpose. An item of property, plant, and equipment should be recognized as an asset. Mean when these things should be recognized as non-current assets. If it is probable that future economic benefit associated with the asset will flow to the entity. Mean if these assets will provide benefit to the business in future, we will recognize them as asset, mean non-current assets, property, plant, and equipment. And the cost of the asset can be measured reliably and its amount can be measured reliably. Mean what is the amount that we can capitalize, that we can calculate reliably. If these are not providing benefit in future or amounts can not be measured properly, then we will not recognize them as asset. And in previous accounting, financial accounting, we have learned about revenue expenditure and capital expenditure. Mean expenditure are of 2 types: revenue nature and capital nature. What is the difference between revenue expenditure and capital expenditure? What is the difference between revenue expenditure and capital expenditure? Expenditure that provide us benefit in less than 12 months. that will be called revenue expenditure, and revenue expenditure we record in profit and loss account, mean we need to expense out them. In those expenditure that provide us benefit in less than 12 months, we need to expense out them, and where we need to record the expenses in profit and loss account. And those expenditure that provide us benefit in more than 12 months, that we should record as asset, where in statement of financial position. Mean capital expenditure should be recorded as asset, means should be capitalized. Capitalized mean recorded as asset. Revenue expenditure should be expense out, where in profit and loss account, where we should capitalize capital expenditure in statement of financial position, mean balance sheet. Okay. So what cost should be included in the asset? What cost should not be included in the asset? Suppose we have bought a car. We purchased a car for say 100,000. We paid car insurance say 5,000. We paid for its registration say 5,000. We installed some accessories into the car for say 2,000. We paid its yearly tax say 3,000, and we run the car for 3 to 5 days, and after running for 3 to 5 days there was some fault in the car, and we paid some repair expenses, that is say 5,000. What cost should be capitalized and what cost should be treated as revenue expenditure? All the costs that are incurred to start the asset, all the costs that are incurred to start the asset, that should be capitalized. So this cost should be capitalized. Obviously, without insurance, we cannot start the car, we cannot use the car. Capitalize registration, we cannot use the car. Capitalize accessories installed, might be those are necessary. Capitalize tax, without tax, we cannot use the car. Capitalize, but this should be treated as revenue expenditure because these are after the starting of the asset. So how much should be capitalized? These should be capitalized, and this should be treated as revenue expenditure. So an item of property, plant and equipment should initially be measured at its cost. Include all costs involved in bringing the asset into working condition, mean all the costs incurred to bring the asset into its working condition, mean to start the asset, those should be capitalized. Include in this initial cost capital, mean the purchase price, such as cost of site preparation, delivery cost, installation cost, borrowing cost, IAS 23. What are these? We will learn later on. And these items should be expense out like fuel, training and warranty cost should be written off as incurred, mean we need to treat them as revenue expenditure, mean these should not be capitalized. What else we need to capitalize? We need to capitalize the dismantling cost in cost of the asset. This is something new that we haven't learned before. Dismantling cost. Dismantling cost. Suppose we have installed a machinery in our business. So this is the area of our business total. And in that area, say here, we have installed a big machinery. This is the machinery that we have installed in our business for production purposes. So the machinery total cost is 200,000. Mean we purchase a machinery for 200,000. And this machinery is having a life of 10 years. This means on 10 years, we need to depreciate the machinery. How much depreciation will be charged? 200,000 every year. But after using for 10 years, we need to remove this machine. And when we're gonna remove this machine, there will be some cost called dismantling cost. Dismantling means when you're gonna remove the machine after end of its life, that will be called dismantling cost. And an engineer who has installed this machinery, he has promised with us, okay, after 10 years, I will help you to remove this machinery, but I will charge 300,000 for the removal. So how much is dismantling? 300,000. That engineer will charge when? After 10 years. When he will charge 300,000? After 10 years. If there is any dismantling cost involved in the asset, we need to capitalize the dismantling cost. How we can capitalize the dismantling cost? By using present value method. By using present value method. We will not capitalize complete 300,000. We need to calculate the present value of 300,000. How we can calculate present value of 300,000? We will multiply this with 1 divided by 1 plus R mean interest rate, raised to power n mean number of years, mean 10 years. This means we will capitalize what? This 200,000 plus the present value of this dismantling cost. But we will capitalize 200,000 plus the present value of this dismantling cost. Can you understand this concept? So dismantling cost, the present value of these costs should be capitalized with the equivalent liability setup. But we need to create a liability for this dismantling cost as well. How? Let's discuss this example. If an oil rig was built in the sea, mean we are going to install oil rig mean machinery in the sea for extracting oil. The cost to be capitalized is likely to include the cost of constructing the asset. Say that is 200,000 in this case. That is 200,000 in this case. This is the construction cost. Constructing the asset and the present value of the cost of dismantling it. If the asset cost 10 million to construct and would cost 4 million to remove in 20 years, mean we're gonna use this asset for 20 years and the purchase price of asset is 10 million, but removal mean dismantling cost is 4 million that we need to incur after 20 years. Then the present value of this dismantling cost must be calculated. If the interest rate were 5%, mean R is 5%, N is what? How many years? 20 years. So we can calculate dismantling cost 1 divided by 1 plus R. R mean 5% raised to power N mean 20. So dismantling cost is 1.507558 million. So the total cost capitalized would be 10 million. This plus this would be this one. So this would be depreciated over 20 years. How much will be the per year depreciation? This one. But each year, The liability would be incurred by the interest rate of 5%. The liability will be incurred by the interest rate of 5% in year one. This would mean the liability increase will be 75378. How this has been calculated? 5% of this amount. This increase is taken to the finance cost where we record the interest in finance cost statement of profit and loss account. We need to capitalize dismantling cost if there is any, but using present value method. And then the interest every year we need to record as a liability, expense debit, finance cost debit, liability credit with the interest amount on this present value amount. Can you understand this concept? So what cost we can capitalize? The cost incurred to bring the asset into working condition should be capitalized. And other costs like training, warranty, fuel, repair should not be capitalized. But dismantling cost, especially on the machinery, removal cost, we need to capitalize, but using present value method. This means we need to depreciate the asset over the cost plus dismantling cost, present value of dismantling cost. And the interest we need to record as a liability as well as finance cost every year. Why we are recording this as a finance cost? Because asset we bought in 10 million, we are capitalizing it 1.11 million. This means we are charging depreciation on this amount rather than 10 million. In fact, we are charging a little bit more depreciation. So that's why we need to count for interest as a liability. That's your understanding one. An entity started construction on a building for its own use on 1st April 20x7 and incurred the following cost. Purchase price of land is 250, stamp duty 5,000, legal fees 10,000, site preparation and clearance 18,000, material we used in the construction of building 100,000, labor we used from 1st April to 1st July construction period 150,000, architecture's fees 20,000, general overhead of 30,000. The following information is also relevant. What you need to do? You are required to calculate the cost of the building that will be included in tangible non-current asset. What cost should be capitalized out of these? There is some information. Material cost were greater than anticipated. What is material cost here? 100,000. That is greater than anticipated. On investigation, they conduct some investigation why this 100,000 is the material cost. It was found that material costing 10 million had been spoiled. In this 100,000, there is a 10 million material recorded that is spoiled. If that is spoiled, this means that is not incurred on this asset. This means we need to deduct that 10 million. What is this 100 million? Out of this 100 million, we need to deduct what? 10 million. And therefore wasted. If wasted, obviously we will not charge to asset cost. We will charge these two as an expense in profit and loss account. And a further 15 million was incurred on material as a result of faulty design work. And due to faulty design work, while manufacturing, while constructing the building, first they constructed the poor design, wrong design. Then they converted into the proper design, and due to this conversion, they wasted 15 million material again. And this should also not be part of this asset cost. This should be treated as expense in profit and loss account. So this 15 million should also be eliminated from here. So 15 plus 10, how much is that? 25. This means this material cost should be capitalized with 75,000 rather than 100,000. Is that fine? Why? Because 10,000 is the material spoiled, wastage. This should be recorded as normal loss in profit and loss account rather than capitalized asset cost. And initially there was wrong design they constructed, and then they moved towards the correct design, and due to moving towards correct design, they wasted 15 million material. This should also be part of expenses rather than capitalized asset cost. As a result of these problems, work on the building ceased for a fortnight during October 20x7, and it is estimated that approximately 9 million of the labor costs relating to this period, and due to these wrong design, new design, the labor was also redundant. Labor was also not working for 14 days. And those 14 days cost is 9 million. This means from this 150, 9 million should also be eliminated. How much labor should be capitalized? 141,000 rather than 150,000. Can you understand this? And the building was completed on 1st July 20x8 and occupied on 1st September 20x8. So what cost should be capitalized? Yes, this should be capitalized. This should be capitalized. This should be capitalized. This should be capitalized. But instead of 100,000, how much material should be capitalized? 75,000. Instead of 150 labor, how much should be capitalized? 141,000. Architecture fee should be capitalized. General overheads. What are general overheads? Mean these are not specific to the asset. General overheads mean not specific to the assets. These are like admin expenses. So these should not be capitalized. This means from this 583, 25,000 should be eliminated. Then 9,000 should be eliminated. And then these general overhead 30,000 should be eliminated. What the amount should be capitalized? Can you calculate that? How much? 509. 519,000 should be capitalized. So this will be our answer. Is it fine? Then that was the requirement. You need to calculate cost of the building that will be included in tangible non-current assets addition. Let's move forward. So these are the initial expenditure. What should be capitalized and what should not be capitalized. Now we are moving towards subsequent expenditure. If an asset has been constructed, after construction, if there are any expenditure, what should be capitalized and what should not be capitalized? Suppose this is our building. It's a door broken. We paid for repair of the door. Whether that repair of the door should be capitalized or not? No, because this cost is not increasing efficiency of the asset. Obviously, if asset efficiency is that much, due to broken door, its efficiency will become down. And if we have repaired the door, the efficiency will move towards its initial position, mean not increased. So subsequent expenditure should be capitalized if they are increasing productive capacity. If increasing, or the proper word is enhancing productive capacity of the asset. Mean efficiency of the asset, then subsequent expenditure should be capitalized. Mean after construction of the asset, if we are incurring any expenditure on the asset, if those expenditure increasing efficiency, productive capacity, or benefit of the asset, that should be capitalized. But if they are just to maintain the benefit of the asset, that should not be capitalized. In this building, we paid some for the whitewash paint. Obviously, if productive capacity of the asset was this, due to poor paint, poor whitewash, its productive capacity will goes down. And by having the whitewash or paint, it will maintain its productive capacity. So whitewash paint should not be capitalized. But if suppose on this building, we have constructed another room on top of the building. Is the construction of another room enhancing productive capacity? Yes, if we rent out that room, we can get more benefit from this building. So that should be capitalized because constructing another room will enhance productive capacity. But for the repair of door or whitewash paint of the building will not enhance its productive capacity. So that should not be capitalized. So what we are learning during construction, what cost should be capitalized, that we have learned. Now we are discussing after construction, if there are any subsequent expenditure, what should be capitalized? Only those expenditures should be capitalized that enhance productive capacity, mean efficiency, mean benefit of the asset. So subsequent expenditure on property, plant and equipment should only be treated as part of cost of asset, means should be capitalized if it enhances the economic benefit provided by the asset, mean productive capacity of the asset or efficiency of the asset. It relates to an overhaul or require major inspection of the asset. Of course, we are running a warehouse where we keep our business inventory. Warehouse. Warehouse cost is say 5 million. And every year, not every year, every 3 years, we need to pay for its inspection. How much we can say 1200,000 for 3 years. In every 3 years, we need to pay 1200 for its inspection, and this is necessary. Without having inspection, we cannot run this warehouse. We cannot store any inventory in this warehouse. This means this warehouse should be depreciated separate according to its useful life, say 10 years. But this cost of inspection we will also capitalize because these are compulsory costs. Without this, we cannot take benefit of the warehouse because these are legally compulsory. What we need to do, we will depreciate this for 3 years. Because after 3 years, we need to incur this cost again. So we will depreciate this cost for 3 years, but this cost we will depreciate for how many years? According to their useful life, say 10 years or 20 years, we will depreciate according to that. So if there is any subsequent compulsory inspection or legal cost, we should capitalize and depreciate over their period. So what second point is saying? The cost, if it relate to overhaul or required major inspection of the asset, the cost associated with these should be capitalized and depreciated over the time until the next overhaul or safety inspection. Because every 3 years we need to pay for the inspection. It is a replacement of a component, like if we have replaced any of the component, like we constructed any other room in the building, that should be capitalized because they are increasing productive capacity, mean efficiency of the asset. Mean what subsequent expenditure should be capitalized that enhance benefit of the asset? Or any inspection overhaul that is compulsory we need to capitalize but depreciate over their period? Or any addition to the asset we will capitalize because they are enhancing productive capacity of the asset. All other subsequent expenditure mean other than these expenditures should be recognized as a expense in profit and loss account. Illustration 2. A piece of machinery has an annual service costing 10,000. A piece of machinery has an annual service costing 10,000. Mean we need to make service of the machinery and we need to pay 1,000. During the most recent service, it was decided to replace part of the engineering, meaning that it will work faster and produce more units of product per labor. Mean through this, it will run faster and will produce more units. This means this service cost is incurred to enhance productive capacity of the asset, enhancing benefit of the asset. The cost of the replacement part is 20,000 on the cost part cost is 20,000. Would this expenditure be treated as asset or expense? So this service cost, if it is legally required, compulsory, we should capitalize. Otherwise, this is like a repair expense, we should expense out. But this 20,000 replacement part of the asset is increasing productive capacity because through this part machine will run faster and will produce more units. If it is producing more units, we are getting more benefits. So this should be capitalized as a non-current asset. So this should be capitalized. This should be treated as revenue. What is depreciation? What is depreciation? Systematic allocation of depreciable amount of an asset over its useful life. Suppose our asset cost is 100,000. We can use this asset for 10 years. And after using for 10 years, we can still able to sell this asset for 20,000. And this is cost. This is residual value. And its life is what? 10 years. This means every year we will charge depreciation by how much? 8,000. This amount, cost less residual value, is called depreciable amount. Cost less residual value is called depreciable amount. So what is depreciation? It is a systematic allocation of depreciable amount. What is the depreciable amount? 80,000 of an asset over its useful life. What's the useful life? 10,000 mean every year we will charge 8,000 to the revenue because this asset we are using in the business and this asset help to generate revenue for the business. So we need to charge cost of the asset to revenue every year. How many years? The years we are using that asset in the business. What is depreciable amount? Is the cost of an asset or other amount substituted for cost, mean less residual value. And depreciation must be charged from the date the asset is available for use. Mean we have constructed the asset and the asset construction completed on 1st of October 2023. But we started using the asset on say 1st of December 2023. So when the depreciation should be charged for the asset, when asset is ready for use rather than when we started using the asset. If the asset is ready for use on 1st October, But we started its usage from 1st December. The depreciation should be charged from 1st October rather than 1st December. So depreciation must be charged from the date the asset is available for use, mean ready for use, rather than when you started its usage. Very important point. I.e., it is capable of operating in the manner intended by management. This may be earlier than the date it is actually brought into use. For example, if the staff need to be trained to use it, depreciation is continued even if the asset is idle. There are different methods of depreciation. One, straight line method, cost less residual value over useful life. Reducing balance method, where we charge a fixed percentage over the written down value. Another method is called machine hours method. What is that? We will learn in future. But we have learned these methods before in our financial accounting, how to calculate depreciation using straight line basis, using reducing balance method basis. I'm assuming you people are sitting in this paper after studying financial accounting. So that's why these methods in detail we are not discussing here. We know about these methods, how to calculate depreciation using this method. We know about that. Okay. A change from one method to providing depreciation to another, if company is changing its depreciation method, that is called estimate change. What is estimate change? Depreciation method changing, useful life changing, or residual value change. If suppose initially when you bought the asset, you measured its useful life is 20 years, and you decided to depreciate asset on a straight line basis, and its residual value was 20,000. But after using 5 years, you are going to change the depreciation method, or you are going to change the useful life, or you are going to change the residual value. That all will be called estimate change. In case of estimate change, it is permissible, mean allowed, only on the ground that the new method will give a fair presentation of the result and the financial position. Mean through this you will not deceiving other, you will maintaining the fair presentation of the financial statement, and does not constitute a change of accounting policy, a change in accounting estimate. Illustration 3. An asset cost 100,000 and has an expected useful life of 10 years. What could be the depreciation? If cost is 100,000, life is 10 years, 10,000. The purchaser intend to use the asset for 6 years. But business want to use it for 6 years. This means business will depreciate it over 6 years rather than 10 years. At which point the expected residual value will be 40,000. But there is a residual value 40,000. So what could be the depreciation? Depreciable amount will be 100,000 minus 40, 60,000. How many years you're gonna use it for? 6 years. So depreciation will be 10,000 per year. What is the depreciable amount? Cost less residual value. If examiner asked to calculate that depreciation, what you will use? 60,000 divided by 6 years, 10,000. Because you have estimated its life for 6 years. After 6 years, you will sell it. Illustration 4. An entity purchased an asset for 20,000 on 1st January 20x3. State line depreciation of 5,000 per annum has been charged. If you are charging 5,000 per annum, this means 20,000 is the cost. You're gonna use this asset for 4 years. 4 years. Every year 5,000. Assuming a 4-year useful life with no residual value. On 1st January 20x5, mean after 2 years, the annual review of asset life was undertaken, and the remaining useful life for this asset was estimated at 4 years. Mean after using for 2 years, you still realize we can also use this asset for further 4 years. The financial statements for the year ended 31st December 20x5 are being prepared. What is the depreciation charge for the year ended 31st December 20x5? What depreciation you will charge for the year 20x5? What we need to do? If we are changing any estimate, we need to calculate the depreciation again. How? Depreciable amount divided by life. This was the first depreciation that we can charge. But in case of change of estimate, how we can calculate the depreciation? Carrying value divided by remaining life. Carrying value divided by remaining life. What is the carrying value at 31st December 20x5? If its cost was 20,000, 5,000 depreciation you charge every year. How many years you have charged the depreciation? 20x3, 20x4 mean 10,000. So the carrying value is what? 10,000. What's the remaining useful life? At 31st December 20x5, sorry, at 31st December 20x5, you are estimating its life as 4 years. So remaining useful life is 4 years. So how much depreciation will be charged? 2,500 per year. Initially, we calculate depreciation using a depreciable amount over useful life. But in case of change in estimate means either we are changing life, we are changing its residual value, or we are changing depreciation method. We need to calculate depreciation. How? Carrying value divided by remaining useful life. So after using for 2 years, you decided its life is still 4 years more. So remaining useful life is 4 years. What is carrying value is 10,000. So how we can calculate depreciation? 10,000 by 4 years, 25. Let's move forward. Major inspection overhauling. Textured understanding 5. An entity purchase an aircraft that has an expected useful life of 20 years with no residual value. 20-year life, no residual value. This means straight line method, cost over useful life. The aircraft requires substantial overhaul at the end of year 5, 10, 15. But airhaul need overhauling after every 5 years. The aircraft cost 25 million, and 5 million of this figure is estimated to be attributable to the economic benefits that are restored by the overhauls. Out of this 25, 5 million was for overhauling. In year 6, the cost of the overhaul is estimated to be 6 million. Calculate the annual depreciation charge for year 1 to 5 and year 6 to 10. Year 1 to 5 and year 6 to 10. We need to calculate depreciation. Out of this 25, the 5 million was for overhauling. This means what is the cost of the asset? That is 20 million. How many useful life? 20 years. So 1 million will be depreciation every year. For this overhauling, we need to depreciate separate because the asset cost is for 20 years. But this overhauling we require every 5 years. So from this 25, 5 million is for overhauling. So asset cost is 20 million. So that should be depreciated over 20 years. But for depreciation of overhauling, that 5 million should be depreciated for 5 years. So that depreciation will be separate 1 million altogether. For year 1 to 5, the depreciation will be 2 million. Is it fine? But from year 6 to 10, mean after 5 years, the overhauling is going towards 6 million. For how many years? 5 years. So this 20,000 will be charged as it is. How much every year depreciation was? 1 million. But overhauling is now 6 million for 5 years. So 6 divided by 5 will be 1.2. So from year 6 to 10, the depreciation annual will be 2.2 rather than. Can you understand this concept? This that we have covered here. Wait. This concept. If there is any inspection or overhaul of the asset for a specific period, then the asset should be depreciated using its useful life, but that inspection or overhaul should be depreciated according to their life. If this inspection is required every 3 years, if overhauling is required every 3 years, so we need to capitalize it, but depreciate using its life rather than total life of the asset. Because every 3 years we need to pay for this inspection or overhauling. The similar they have covered in this question. The overhaul required every 5 years. And the asset total is 25. And in this 25, 5 million is for overhaul of year 1 to 5. That we have capitalized. But while charging depreciation, this overhaul will be charged according to their life. Their life is 5 years. But the asset cost should be depreciated over its life, and asset appreciation is according to 20 years. And after 5 years, the overhaul is going to be increased to 6 million instead of 5 million. This means for year 1 to 5, overhaul cost depreciation will be 1 million, 5 million divided by 5 years. And asset should be depreciated using 1 million, 20 million cost divided by 20 years. But for year 6 to 10, the overall cost is 6 million. So this should be depreciated 6 million for 5 years, 1.2, and asset should be charged 20 years life, mean 1. So for year 6 to 10, depreciation will be 2.2. For year 1 to 5, depreciation will be 2. Can you understand this? Now we are moving towards revaluation of assets. We have learned in financial accounting, revaluation mean asset business can record on 2 methods. One is called cost model, other is called revaluation model. What is cost model? We will record asset how? Cost less accumulated depreciation. Our business can choose to record their property, plant, and equipment on revaluation method. Revaluation method means according to market value. According to market value. Suppose we bought the asset, mean asset cost is 100,000. Its accumulated depreciation until now we have a charge for 20,000. Mean this is its Carrying value 80,000. Carrying value, what is carrying value? 80,000. Now this asset market value is 150,000. What is this? Market value. So companies having option, either they can keep their asset like this as it is, or they can move towards revaluation model. But if you are moving towards revaluation model, then all the asset in the same class should be revalued. This means your asset carrying value is 80,000. Now this asset is in market for 150,000. So if you are moving towards revaluation model, you will record your asset on 150 rather than 80. How much is the value up or down? Is 70,000 up. That will be called revaluation gain. And this revaluation gain should be recorded in other comprehensive income. Or we call it revaluation surplus. What will be the accounting entry for this? This revaluation surplus is a part of equity, and equity is a credit nature. And when credit nature item increase, we need to credit it. So revaluation surplus will be credited with how much? 70,000. And when we are moving toward revaluation basis, all the amount in accumulated depreciation we need to eliminate. How we can eliminate? By debiting accumulated depreciation. What is the amount in accumulated depreciation? 20,000. And the difference we need to debit where? Asset cost. How much is the difference? 50,000. Or this difference is the difference between cost and market value. Mean asset should be debited with the difference between asset cost and market value. Asset should be debited with the difference of asset cost and market value. All the amount in accumulated depreciation relating to this asset should be eliminated by debiting it. And on the credit side, we need to record revaluation surplus. And revaluation surplus is the difference between carrying value, mean value now in our book, and market value, mean value in the market for this asset. Can you understand this concept? This is the accounting entry of revaluation gain, where revaluation gain should be recorded in other comprehensive income. Where revaluation gain should be recorded in other comprehensive income. If suppose carrying value is 80,000, but its market value is 70,000. Is there gain or loss? Loss of how much? 10,000 loss. That should be recorded in profit and loss account. If there is a revaluation gain, that should be recorded in other comprehensive income, not profit and loss account. But if there is a loss, that should be recorded in profit and loss account. Is that fine? And if we are moving toward revaluation basis, now we will depreciate our asset on the revalued amount, mean new amount. So asset cost was 100,000. Suppose its useful life was 10 years. This means we were depreciating this asset for 10,000 every year. Without revaluation, we were depreciating this asset for 10,000. Now its value become 150,000. Now we need to depreciate using this value. Suppose the depreciation using this value is 15,000. Without revaluation, we were charging depreciation 10,000. Now, if we are moving towards revaluation, we will charge depreciation 15,000 every year. How much depreciation we are charging more? How much charging we more? 5,000. For this 5,000 extra depreciation, what is this? Extra depreciation due to revaluation. We need to record accounting entry debit revaluation surplus, credit retained earning. How much? With the extra amount of depreciation. And this entry will be having effect where statement of changes in equity rather than profit and loss, rather than comprehensive, rather than balance sheet. This will be having effect where in statement of changes in equity. In statement of changes in equity, there are almost share capital, share premium, revaluation reserve, retained earning. What you will do? We will deduct from revaluation surplus and we will add to retained earnings. Because due to this 5,000 extra depreciation, our current year profit going down. So we are charging to the retained earning, mean with the profit 5,000 from where? From revaluation surplus. So company has an option, either they can recognize their asset on cost model or revaluation model. If they are recognizing on cost model, how they will record asset, cost less accumulated depreciation every year. But if company is moving to a revaluation model, then they need to compare carrying value with market value. And the difference between carrying value and market value is either revaluation gain or revaluation loss. And revaluation gain should be charged to other comprehensive income, and revaluation loss should be charged to profit and loss account. And we need to depreciate our asset over the revalued amount, mean new amount rather than previous amount. And in case of revaluation, if we are charging any extra depreciation, for that extra depreciation, we need to record accounting entry, revaluation surplus debit, retained earnings credit. Can you understand this concept? Okay, let's move forward. So IAS 16 allows a choice of accounting treatment for property, plant and equipment, either on cost model or revaluation model. The cost model, property, plant and equipment should be valued at cost less accumulated depreciation like this. But if you are moving towards revaluation model, property, plant and equipment may be carried at revalued amount less any subsequent accumulated depreciation. If the revaluation alternative is adopted, mean if you are moving towards revaluation model, two conditions must be complied with. Revaluation must subsequently be made with sufficient regularity, mean every year you need to record your asset on revaluation basis now. Mean you need to compare the carrying value with the market value. And when an item, property, plant and equipment is revalued, the entire class of asset to which the item belong must be revalued. If you are revaluing your land and buildings, then you need to record all the land and buildings on revaluation basis. It's not like that where you are having a gain, you are recording on revaluation, where you are having a loss, you are keeping them on cost basis. No, it's not allowed. All the asset in the same class should be recorded on revaluation basis. There is no selective revaluation allowed. And accounting for revaluation, what we will do, revaluation surplus, we will credit. And this is the difference between carrying value and market value. Asset we will debit. This is the difference between market value and cost. And whatever is in the accumulated depreciation account relating to that asset, we will eliminate by debiting it. The similar way we have performed this accounting and asset cost was 100,000. Market value is 150. So difference between these two is asset. But carrying value and market value difference is revaluation gain, revaluation surplus. Whatever is in the accumulated depreciation that we need to eliminate by debiting it, because accumulated depreciation account nature is credit. How we can eliminate credit nature? By debiting it. And this we have already learned in financial accounting. There is nothing new. Revaluation gain and loss, where this should be recorded. Revaluation gain are recorded as a component of other comprehensive income. Gain should not be recorded in profit and loss account. Make sure gain should not be recorded in profit and loss account. It should be recorded in other comprehensive income. Either within statement of profit or loss and other comprehensive income are in a separate statement. Either you are comparing combined or separate, but it should be recorded under other comprehensive income. This gain is then carried in revaluation surplus within the equity. Obviously, in statement of changes in equity, this will be part of equity. This revaluation surplus is capital reserve, being part of equity, and is therefore not permitted to distribute to the shareholder, because to shareholder we will distribute dividend from retained earning rather than revaluation surplus. In case of revaluation loss, which represent an impairment of an asset value, we will record in profit and loss account. How? As impairment of asset. If carrying value is 80,000, market value is 70,000, so 10,000 is the loss. We will record where? In profit and loss account as impairment of asset. Are recognized in the statement of profit and loss account. When a revaluation loss arises on a previously revalued asset, mean if this asset we revalued in previous year, very important concept. If in previous year we revalued the asset and there was a gain of say 20,000, where it is in revaluation surplus, but for the current year there is 10,000 loss, where loss should be recognized in profit and loss account. But if the similar asset is having a revaluation surplus as opening balance, then we can adjust with the revaluation surplus. Now the revaluation surplus will remain with 10,000. If this asset doesn't have any opening balance of revaluation surplus as of previous year, then this revaluation loss should be charged to profit and loss account. But if the similar asset in previous years of us having revaluation gain, mean revaluation surplus, then we can adjust the revaluation loss to revaluation surplus. Suppose the current year loss is 30,000. And this asset is having opening balance of revaluation surplus of 20,000. So 20,000 we will adjust with the revaluation surplus, and remaining 10,000 we will record to P&L expense. So revaluation loss should be charged to profit and loss account. But we can adjust with the revaluation surplus if the similar asset is having previous revaluation gain balance. Because in previous year, it was revaluation gain, where we charge to revaluation surplus. And now for current year, there is a revaluation loss. So first we need to see if there is any opening balance of revaluation surplus relating to this asset, we will charge to revaluation surplus. If there is no revaluation surplus relating to this asset in previous year, we will charge to profit and loss account. I'm reading it once again. Revaluation loss which represent an impairment of asset value are recognized as statement of profit and loss account, mean loss should be charged to profit and loss account as impairment of asset. When a revaluation loss arises on a previously revalued asset, it should be deducted first against the previous revaluation gain and can therefore be taken to other comprehensive income in the year. Any excess impairment will then be recorded as an impairment expense in statement of profit or loss account. Note that offset of gain and losses between different assets is not allowed. If revaluation surplus is having opening balance, but that is relating to any other asset, not this asset where we are having loss, then this loss cannot be offset with revaluation surplus. This should be recorded in profit and loss account as expense. Can you understand this concept? Where we should record revaluation gain to other comprehensive income, and we will record as revaluation surplus part of equity. Where we should record revaluation losses to profit and loss account. But if this loss-making asset is having any opening balance of revaluation surplus relating to previous year, then this loss can be adjusted to revaluation surplus rather than profit and loss account. Illustration 6. An entity revalues its building and decide to incorporate the revaluation into the financial statement. Extract from the statement of financial position as at 31st December 2027 are building cost is 1200 and depreciation charge, and this is its carrying value. The building is revalued at 1st January 2028 at 1400,000 and its useful life is 40 years at that date. So this is market value. This is carrying value. Is there any gain or loss? Is there any gain or loss? Gain, how much? 344 revaluation gain. That should be charged to revaluation surplus under other comprehensive income. You know? And now we need to depreciate this asset using this value 1400 divided by 40 years. How much is depreciation? 35. So this will be charged to other comprehensive income. This will be charged to profit and loss account as depreciation. Is that fine? Is that fine? So the relevant extract from the financial statement at 31st December 2028. So 35 will be charged at depreciation, where to statement of profit and loss account, and this 344 should be charged at revaluation surplus to other comprehensive income. And land and building value is a 1400 minus 35 will be recorded as 1365 in statement of financial position, and the 344 will be recorded as what? Revaluation surplus, where in statement of changes in equity mean part of equity. Is it fine? There is no information. What was the depreciation rate in previous year? What was they were charging per year depreciation in previous year? If that information is there, so we can compare this 35 with the previous depreciation, and if it is more, we need to record accounting entry revaluation surplus debit and retained earning credit with the extra depreciation, but there is no information about previous year per year depreciation. So new depreciation we know 35 per year. What was the previous per year? We don't have information. That's why we are not recording that entry. What was that entry? Debit, revaluation surplus, credit, retained earning with the extra depreciation amount. but we don't have information about that. What was the extra depreciation? For extra depreciation, let's take a break for 20 minutes. After break, we will discuss remaining things.
That's just like, yeah, sorry.
So we're discussing about revaluation of asset. Revaluation of asset. These are the things they have stated here. In case we are moving towards revaluation, we need to charge depreciation over the revalued amount. And in case of revaluation, if we are charging extra depreciation as compared to previous year, for that extra depreciation, we need to record this accounting entry debit revaluation surplus and credit retained earnings with extra amount of depreciation. Mean depreciation on previous valuation and depreciation original cost mean previous and revaluation basis. And this is having effect on statement of changes in equity only. Okay, test your understanding too. On 1st April 20x8, the fair value of shoes property was 100,000 with a remaining life of 20 years. Shoes policy is to revalue its property at each year end. And at 31st March 20x9, the property was valued at 86,000. The balance on the revaluation surplus at 1st April 20x8 was 20,000, which relates entirely to the property. Shoe does not make a transfer to realized profit in respect of excess depreciation. Prepare extract of Shoe's financial statement for the year ended 31st March 20x9 reflecting the above information and state how accounting would be different if the opening revaluation surplus did not exist. So 1st April 20x8 fair value of Shoe's property was 100,000. I mean, this is carrying value with the remaining life of 20 years. Shoe policy is to revalue its property at each year end. And at 31st March 20x9, in at year end, property was revalued at 86,000. Carrying value was 100,000. Now the value is 86,000. Carrying value was 100,000 or something different. Carrying value was 100,000 or something different. At 31st March 20x9. If it is depreciating using 20 years life, will be 95. How? 100,000 at start of the year divided by 20 years life. So depreciation will be 5,000. So carrying value will be 100 minus 5 is equal to 95,000, while market value is what? 86,000. Is there any loss or gain? Is there any loss or gain? Loss. Because market value is lower than the carrying value at 31st March 20x9. So how much is the loss? 9,000. 9,000. Where this loss should be charged? Profit and loss account. But if you are having revaluation surplus opening balance relating to similar asset, then this should be charged to revaluation surplus. So you are having at 1st April in revaluation surplus 20,000. So where this should be charged? To revaluation surplus. So what he's asking, prepare extract of Shoe's financial statements for the year ended 31st March 20x9. You need to prepare financial statements extracts. So statement of profit and loss and other comprehensive income, if we say, so in other comprehensive income, we will record this loss revaluation. Loss of how much? 9,000. And in statement of financial position, we will record non-current assets at what amount? 86,000. And we will record revaluation surplus, that will be with how much? 20,000 was balance. This 9 loss we adjusted with 11,000. Can you understand this? This is part 1. Now moving towards part B, if there is no opening balance in the valuation surplus exist, then statement of profit and loss and other comprehensive income, we will record impairment of asset, how much? 9,000 as loss. Where? In profit and loss account. Because it cannot be adjusted. The loss should be charged to profit and loss account. Only gain should be charged to other comprehensive income. And in statement of financial position, we will record non-current assets at what amount? 86,000. Is it fine? There is no revaluation surplus. Because part 2 saying there is no balance in revaluation surplus. Question understanding 3. An entity revalued its land and building at the start of the year to 60 million. Out of this 60 million, 15 million is for land. This means remaining 45,000 is for building. You know, this is the revalued amount, mean market value. What is that? Market value. The property cost 30 million. Out of this 36 million for land, this means 24 million for building. 10 years prior to the revaluation. 10 years prior to the revaluation. The total expected useful life of 40 years remained unchanged. Mean building life was 40 years, 10 years back. The entity's policy is to make an annual transfer of realized amount to retained earning, and they transfer extra depreciation to retained earning as well. Show the effect of the above on the financial statements for the year. How much is the revaluation gain or loss? How we can calculate revaluation gain or loss? By comparing carrying value with market value. Are we having carrying value in this question? No, this means we need to calculate carrying value first. We need to calculate carrying value first. And there are two types of assets, land and building. The cost of land is what? 6 million. We can say it's a 6,000, while building is 24 million. Figures in thousand. What's their accumulated depreciation? How we can calculate accumulated depreciation? There is no depreciation on land. There is depreciation on building. How? 24,000. How many years? 40 years multiply by 10 years. What's that? 6,000. This means carrying value. 6,000 for land, while 18,000 for building. Now the market value is what? 15,000 for land and 45,000 for building out of 60. Enough? So what is revaluation gain or loss? Revaluation surplus. How much? 9,000 for this and 27,000 for building. Is that? The entity policy is to make an annual transfer of realized amount to retained earning. Okay. This means for the current year, depreciation should be charged on 45,000 and the life remain same. Mean now the remaining useful life is 30 years. So for statement of profit and loss and other comprehensive income, what we will record? We will record for profit and loss, we will record depreciation. For the current year, how much is the depreciation? 45,000 divided by 30 years mean remaining useful life. What's that? 15,000. This should be charged at expense. And we need to record for other comprehensive income what? Revaluation surplus. How much is that? 27 plus 9. 36,000. For both land and building, So this will be the extract for statement of profit and loss and other comprehensive income. Now we need to move towards statement of financial position, non-current assets. So what will be the non-current asset value? What could be the non-current asset value? 60,000 minus 1,500. So property, plant and equipment should be 60,000 minus 1,500 altogether. How much? 58,500. Because the new value is 60 and the depreciation for building current year is 1,500. What should be the value for revaluation surplus? What should be the value for revaluation surplus? Is that 36,000? No. We need to record extra depreciation, adjust extra depreciation. What was the new depreciation? 1,500. What was the old depreciation? Old depreciation. How much? 24,000 divided by 40 per year. 600 was previous depreciation. 24,000 divided by 40. So old depreciation was 600. New depreciation per year is what? 1,500. So what's the extra depreciation we are charging? 900. And for this, we need to record accounting entry what? Debit revaluation surplus, credit retained earning 900, and this will be having effect on where statement of changes in equity. So revaluation surplus will be 36,000 minus 900, and that will be 35,100. Can you understand this question? Is that clear? Mean these will be the extract of the financial statements for statement of financial position and statement of profit and loss and other comprehensive income. Okay, let's move forward. In case we are disposing of non-current assets that was previously revalued, what we need to do, the gain or loss on disposal we will charge to profit and loss account. Gain or loss on disposal, how we can calculate gain or loss on disposal? Asset value in our book compared to sale proceed. Suppose in our book asset value is 90,000 and we are selling it for 100,000. So there is a 10,000 gain. This gain should be charged to profit and loss account. I mean, this is sale and this is book value. Suppose we are selling on 80,000. So there will be 10,000 loss that should be charged to profit and loss account. I mean, gain or loss on disposal should be charged to profit and loss account. But as we are selling an asset that was previously revalued, this means relating to this asset, there is some balance in revaluation surplus account that we need to eliminate on the time of disposal. I mean, whatever will be in the revaluation surplus relating to this asset that we are going to dispose of, we need to record that entry again. What? Debit revaluation surplus, credit retained earning. In this entry, we need to record in two situations. One situation, in case of revaluation due to extra depreciation over the revalued asset, we need to record this accounting entry. Revaluation surplus debit retained earning credit with extra depreciation. And when we are selling any asset that was previously revalued or having a opening balance, remaining balance in revaluation surplus. So at the time of disposal, we will record this entry, mean whatever is in the revaluation surplus relating to this dispose of asset, we need to eliminate and will transfer to where? Retained earnings. Mean for revaluation asset, we need to record this entry in two situations. First situation in case of extra depreciation, and second situation in case of disposal of the asset that was previously revalued and there was a gain. So any balance on the revaluation surplus relating to this asset that we are going to dispose of should now be transferred to retained earning. How? By recording entry, revaluation surplus debit and retained earning credit. Test your understanding 4. Please try by yourself. Please try by yourself. Test your understanding 4. So direct purchased a property costing 750 on 1st January 20x4. This is the cost of the asset with a useful life of 10 years. What could be the depreciation per year? 75. It has no residual value, 75. At 31st December 20x4, the property was valued at 810, resulting in a gain on revaluation being recorded in the other comprehensive income of 135,000. Mean there was a gain, mean revaluation reserve, surplus, 135,000 recorded. There was no change to its useful life. Mean useful life is still 10 years. Direct does not make a transfer to realized profit in respect of excess depreciation on revalued asset. Mean he do not record accounting entry relating to extra depreciation. He do not record. This means revaluation surplus balance will remain 135,000. On 31st December 20x6, mean after 2 years, the property was sold for 900,000. And this property is having revaluation surplus balance of 135,000. How should the disposal on the previous revalued asset be treated in financial statements for the year ended 31st December 20x6? But you will record where. So you are selling the asset with how much amount? 900,000. What's the carrying value at 31st December 20x6? What's the carrying value at 31st December 20x6? So value at 31st December 20x4 was so sale value is 900 and value at 31st December 20x4 was how much? 810. And depreciation for 20x4, 20x5 and 20x6, how much? 810 divided by what was the remaining useful life when you revalued. If 10 years was alive, you bought on 1st January at 31st December, so remaining useful life was 9 years. How many years you have charged depreciation in previous 2 years? How much is that? So what is the value at 31st December 20x6? 630. So this is the sale proceed 900, 630 is the value, is there profit or loss? So gain on disposal that should be charged to profit and loss account. How much? 270. And as you are selling an asset that was previously revalued, so you need to record accounting entry, debit, revaluation surplus with how much amount, whatever is there relating to this asset, and credit, retained earning with how much? 135,000. And this should be recorded where? In statement of changes in equity. Is that
You explain the second part.
Mean when we are disposing of an asset that was previously revalued. So whatever is in revaluation surplus, this asset we need to it how revaluation surplus debit retained earnings credit. In this entry, we need to record in two situations. One in case of extra depreciation due to revaluation, and second in case of disposal of revalued asset. Because this asset is going, so its revaluation surplus will also we need to eliminate. And where we need to transfer to retained earnings. Okay, now moving towards another accounting standard, that is IAS 20 government grant. IAS 20 government grants. Government grants. Sometime government of the country provide us grant. Why they will provide us grant? Might be there is an old area in the country and that is very depressed economically, and government has asked us or has requested us, if you move your business to that area, we will provide you some grant. Because if you will move your business to that area, obviously you will provide employment opportunities over there. And by having employment opportunities, that area might be improved. So that's why government is paying us grant. The government grants are of two types: revenue nature and capital nature. Capital nature means government has asked us, you move your business or start a new business in that area, and I will provide you government grant of say $200,000 for machinery installation. Whatever will be the cost of the machine, I will provide you 200,000 for the machine. Mean that is relating to asset. This is called capital nature government grant. Or sometimes government provide us a grant revenue nature. Revenue nature mean relating to running expense of the business. Mean government is saying, I will provide you for your business expenses how much, say 60,000 for 3 years. This means if government is providing 60,000 for 3 years, this will be 20,000 each year that we need to use. Can you understand this? In government provide grants of two types: revenue nature, mean relating to routine expenses of the business, day-to-day expenses of the business, or capital nature, mean relating to installation of asset. Capital nature mean relating to asset. Revenue nature mean relating to day-to-day expenses of the business. What is the accounting treatment for revenue nature government grant? What is the accounting treatment for capital nature government grant? Let's discuss. If government has provided a revenue nature grant 60,000 for 3 years, how we can account for it? This means this 60,000 is for 3 years. How much each year? 20,000. We will record in year 1 income in profit and loss account as 20,000, and remaining 40,000 we will record as liability. Because for the current year, 20,000 income. And this is our income because government providing us and will not get back. So this is our income, other income. And in year 2, we will record income 20,000 and our liability will remain 20,000 because 20,000 from liability we have transferred to income, mean liability debit, income credit. And in year 3, our income will be 20,000 and our liability will be nil. Mean this is the way we record revenue nature government grant. Mean for how many years we need to charge every year the part of income and the remaining we should record as liability. Why liability? Because if we not use it, government can call back. What is the accounting treatment of capital nature grant? What is the accounting treatment of capital nature grant? If suppose government has provided us grant for 20,000. We bought the machinery for 50,000, 500,000. In actual cost of machinery is 500,000. What we will do, we will deduct the government grant from this actual cost. How much government has provided us? 200,000. So with the remaining 300,000, we will record our asset in the balance sheet and we will charge depreciation on this 300,000. Can you understand this? This is one treatment. We can deduct the government grant from asset cost and with the remaining amount, we can record the asset and we will charge depreciation on the remaining amount of the asset. Or what we can do, we can record machine cost with 500,000 separate as a asset. And we will charge depreciation on its 500,000, say 10 years life. And the government grant we will record as a liability, say 200,000. And we will charge the depreciation on it separate. But this will be depreciation credit rather than debit. Obviously, if 10 years is alive, we are charging 50,000 depreciation and 20,000 will be credited from here. In net, depreciation will be charged to P&L 30,000. Mean either we can adopt this method or this method, both are accepted. But for revenue, we need to record income in the year relating to which it is, and the remaining amount that we're gonna spend in future, that we will record as liability. Can you understand this? Let's discuss what is government grant. So government often provide money or incentive to companies to export their goods or to promote local employments. In sometimes government encourage companies to produce more so that government can increase export, because by increasing export, government can manage their foreign exchange currency rate. Government grant could be revenue grant, i.e. contributing towards a payroll, mean running day-to-day expenses, or capital nature, for example, contributing towards purchase of non-current assets like machinery, plant and machinery, land and building. And IAS 20 follows the two general principles when determining treatment of grants. Grant should not be recognized until the condition for receipt have been complied with and there is a reasonable assurance the grant will be received. And grant should be matched with the expenditure towards which they were intended to contribute. Mean should be adjusted with the expenditure. Like for even this, suppose our yearly expense is 300,000. So we can adjust the income with this expense, and with the remaining 100,000, we can record the expense in profit and loss account. Or record this expense separate and income separate. The net effect will be 100,000 in the income statement. Government refers to government agencies and similar bodies, whether local, national, or international. Mean if any body from outside the country providing you grant, that will also be treated as government grant. Government assistance is an action by government designed to provide an economic benefit specific to an entity. A range of entities qualifying under certain criteria. Mean this is government providing you assistance. Government grant are assistance by government in the form of transfer of resource to an entity in return for past or future compliance with certain conditions relating to the operating activities of the business. Means sometimes government say, okay, you can spend your expenditure, I will pay you afterward. Mean that is relating to past expenditure. Okay, for your future expenditure, every year I will pay this. This is relating to future business activities. Grants related to assets are government grants whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire long-term assets. Mean could be capital nature. Are grants related to income and government grant other than those related to assets known as revenue grants. Mean there are two types of grants: capital nature grant and revenue nature grant. What is the revenue nature grant and how they can be accounted for? The recognition of the grant will depend upon the circumstances. If the grant is paid when evidence is produced that a certain expenditure has been incurred, the grant should be matched with that expenditure. Mean you can use the grant only for that specific expenditure, not for other expenditure. If the grant is paid on a different basis, for example, achievement of a non-financial objective such as the creation of specified number of new jobs, means sometimes government provide you grant like you need to provide 500 new jobs in the community, I will provide you some grant. And the grant should be matched with the identifiable cost of achieving that objective and presented as credit in statement profit and loss account are deducted from the related expense. Mean we can record grant in two ways, either record as income or as a net of expense. Mean expense minus income, you can record net expense. And revenue grant presentation presented in statement of profit and loss account. How you can record as a separate income and the remaining amount you can record as a liability, or you can deduct from the related expense and net expense you can record. Illustration 7, please. An entity is given 300,000 on 1st January 20x1 to keep staff employed within a deprived area. The entity must not make redundancies for the next 3 years. This means this 300,000 is for 3 years. Because the condition, you will not make redundancies on employment for next 3 years. Or the grant will need to be repaid. If you make redundancy, government can call back their grant. By 31st December 20x1, no redundancies have taken place and none are planned. The grant should be released over 3 years, meaning that 100,000 is taken to the statement profit or loss each year. This can be shown as a separate line in the statement of profit or loss or deduct from admin expenses. As 100,000 has been released to the statement of profit and loss account as income, the remaining 200,000 will be held as deferred income and recognized over the next 2 years. Deferred income means record as liability. In next year too, 100,000 will be recorded as income, and what will be the liability? 100,000 as deferred income. In year 3, we will record 100,000 income and the liability will become nil. Yeah. Okay, what is the treatment of capital nature grant? Capital nature is relating to cost of non-current assets. Either we can deduct from the cost of asset or we can record is separate as a liability. I mean, there are two methods of recording capital nature grant. Method one, on initial recognition, deduct the grant from the cost of non-current assets and depreciate the reduced cost. Like 50,000 is the cost actual, 20,000 is a government grant. You can record asset with 30,000 and depreciate 30,000 over useful life. The second method, recognize the grant initially as deferred income in liability and transfer a portion to revenue each year. Mean transfer a credit depreciation. Normally depreciation expense is debit, but through liability you will provide credit, offsetting the higher depreciation charge based on the original cost. This is method two. Test your understanding 5. An entity opens a new factory and receive a government grant of 15,000 in respect of capital equipment costing 100,000. Mean your asset cost is 100,000, but government providing you 15,000 as a grant. It depreciate all plant and machinery at 20% per annum straight line. Show the statement of profit or loss and statement of financial position extract in respect of the grant in the first year under both method. According to both method, you need to show financial statements extract. Good luck, everybody, please. Either deduct from asset cost and then calculate depreciation on the reduced amount, or record asset on 100,000 separate, 15,000 grant separate, and then record depreciation accordingly. So method one. Statement of profit and loss. And statement of financial position. According to method one, what depreciation we will charge to statement of profit and loss account? 100,000 minus 15,000 is equal to 85,000. So 85,000 into 20%, how much is that? 17,000. That's it. And for statement of financial position, non-current assets, we will record at what? 85,000. How? 100 minus 15. And accumulated depreciation, we will record how much? 17,000. And carrying value, how much will be there? 68,000. So this is your method one. Now method 2. See, it's a little bit tricky. So statement of profit and loss and statement of financial position. So how we gonna record here? The non-current assets. Non-current assets. We will record with the complete amount 100,000. Mean we are not deducting grant. We will record grant as a liability. What will be the accumulated depreciation? 20% of this 20,000. So carrying value of non-current assets will be 80,000 and we will record depreciation here at 20,000. Is that? And we will record the government grant as what? Deferred income liability. With how much amount? Where? Non-current liability. Deferred income. How much of it? Total amount is 15,000. Total amount is how much? 15,000 minus what is the depreciation on 15,000 at the rate of 20%? 3,000. So that we will record here what? Government grant credit as positive figure. As positive figure. And the net effect will be that 17,000. So out of this 15, 3,000 we have paid the depreciation. For how many years? In the next year, we're gonna also depreciate credit 3,000. That should be recorded as current liability. How much? 3,000. For the next year, that we need to settle in 12 months, that we need to transfer as a credit to P&L in next year. This means this 15 minus 3 with 9,000 we will record as a non-current liability, and with the 3,000 we will record as current liability. Can you understand this? I mean, total is 15,000. Out of this 15, 3,000 we need to transfer to profit and loss account. This means remaining 12 left. But how this is 12, we need to settle 3,000 in coming 12 months. So we will record this as a current liability, and remaining 9,000 we will record as non-current liability, means that will continue after 1 year. Is that fine? And what is the net effect on method 1 on statement of profit and loss account is a 17,000 same. And if you see the statement of financial position effect, 68,000 on asset side. 80,000 minus this 12,000, the same 68,000 on positive side. The effect on both will be same, but the recording method are different. Okay. If government pay you grant, government always pay you grant with certain conditions. And if your business is not fulfilling that condition, government can call back the grant. And if you are not fulfilling the condition, this means there are chances of repayment of grant. And if business is having a repayment of grant chances, they need to create a provision as per IAS 37. If there are chances, business need to repay back the grant to the government. Either business didn't fulfill the condition attached to the grant. So in that case, business need to create provision per IAS 37. If the deferred income method for capital grant has been used, then the remaining grant would be repaid to the government. That's fine. So that's it for today, I think so. We have covered two accounting standard. There are two more accounting standard left, IAS 23 and IAS 40. That probably we will discuss in next class because I'm fasting. So feeling hungry now, unable to speak now.
Yes, ma'am.
So see you in next class.
Okay.
Until then, please cover these practice questions that we have covered in the class. Try to solve them by yourself again. So we have covered IAS 16 and we have covered IAS 20 government grant. The chapter is not completed. There are two small standards left that we will cover in next class.
Thank you, sir.
See you in next class.